Euro Swissy, I mean, Doug Cliggott, look at Euro Swissy driving down here. Look, it's just strong Swiss strength. I mean, it shows some of the instabilities that are out there. Why do equities continue to do so well given worry A or worry B or worry C?
It's the power of money, Tom. It comes back to this $20 billion a week in flow. There is more to it than that, though.
Right.
I mean, when we look around the world, right, we are not real optimistic about U.S. equities for the next 12 months. But for the next 5 to 7 years, it's really hard for us to come up with a better investment.
Okay. I like that. From Morgan Stanley, Gregory Peters with us. Good afternoon, sir.
Hi, how are you, Tom?
Well, good. Let's bring up your research note right away here, Rex. See if you can drag that out of the file there. Take my coffee cups off the top of the file. There it is, Morgan Stanley. Look past the headline. We expect growth to be resilient. Investors are less optimistic. The strongest pushback on our call to stay long is our growth outlook is optimistic. Let's look at Greg Peters again. Bring him up. You see the bruise over his right eye? That wasn't from a hockey game. One of his clients hit him over the head when he was optimistic. You've never seen the clients this angry, have you?
Well, that's not true. You know, client's been angry for quite some time. No, look, I mean, you know, this is a very interesting time in the markets. Depending on your thesis, whether you're bullish or bearish, you can actually select a data set to fit that thesis. And so the confusion around the data and the interpretation of the data is so difficult right now that I can understand why there's tremendous amount of pushback on our end.
And you guys are both getting this. Let's look at Greg Peters' chart here of optimism. German GDP. That's the level of German GDP, and it is optimistic given all the gloom. Can Germany and the other Germanys in the world, Greg, can they sustain that economic growth?
Well, that's the real question that investors are wrestling with. Now, from our perspective, we actually think there is stronger underlying growth than what the headlines are showing. And the data are very mixed. We know that. That's going to keep the markets on edge. But if, you know, just take the first quarter as an example. We saw a tremendous revision down on the first quarter in U.S. GDP. At the same time, Doug knows this, we witnessed pretty strong earnings growth, and earning revision patterns are actually pretty strong. So the disconnects are everywhere, and the interpretation of the data is incredibly difficult. So we're taking the side that there is a sustainability here in the recovery, and we're not willing to give up yet, and we think the recovery is too young to die, as we say.
Well, let's bring in another optimist here. Doug Cliggott, optimistic on earnings, at least for now. Doug, ask a question here of Mr. Peters of Morgan Stanley.
Greg, given your sort of glass half full, the optimistic case on growth, I'm looking at one of Tom's screens here right now, 10-year U.S. Treasury yield of 3.13. Where do you think we'll be 6 months from now if, you know, over, say, that 6-month period, the optimistic case plays out, and in fact, we're overdoing it on growth pessimism now? Do we go over 4? Do we go to 4.5? Where might the 10-year yield be 6 or 9 months from now?
Well, you know, calling the 10-year Treasury has been very hazardous to one's health of late.
Really?
But
I didn't know that.
I'm acutely aware of that. But
Cliggott, you really got that in, didn't you? You go to the 2 minutes. 2 minutes. Cliggott, 2 minutes. Illegal beating of Morgan Stanley. Continue, Greg, please.
We're wrong about a lot more stuff than Greg is. So I mean, come on.
Mr. Peters, continue.
But I do think, I mean, the tendency will be towards higher yields, but at the same time, I don't see a dramatic move in yields. Really, until you start to see lending pick up, I don't have the expectation, at least, or Morgan Stanley doesn't have the expectation that yields will rise in a meaningful way. And so, yes, if optimism around growth and inflation start to pick up, that should translate into higher yields. But I really believe unless you see lending pick up in a meaningful way, yields are somewhat range-bound.
Doug, again,
so, yeah, Greg, if we go far back in time, if we look at sort of the 50s, 60s, 70s, the last time the U.S. was trying to work down a very, very high government debt level, for a lot of those years, 10-year Treasury yields were actually lower than the rate of inflation. Right now, I think CPI inflation is 3.2, 10-year yields 3.1. Are we entering sort of a new period where the 10-year yields more often than not going to be below measured inflation in the U.S.?
Well, I've heard that, and when I do think there's that possibility, as long as you see this highly accommodative environment, I do think that will be the tendency. I think policymakers are quite willing to let inflation run, ultimately, I believe it has to be reconciled. But I think near term, Doug, you're quite right. I'm just not willing to say this is a regime shift.
Everybody except Joachim Fels speaking on Europe today. Greg Peters, let's go to the chart here. Greece distracted. I've never shown this chart before. It's just Greece exports. Greece exports set in euro, and you can see the boom up to 09, and then you can see there how it drops down. I mean, this is a big deal. Greece is distracted. Greg Peters, how much of a drag is a peripheral solvency issue on the rest of Europe?
Clearly, that's going to manifest itself through lower growth going forward. I think the markets understand that, but the markets aren't trading that. I don't think the markets are trading the austerity effect going forward. I think what it's trading is really just a near-term resolution. And the markets have spoken. I think it's been a real wake-up call to policymakers and politicians that it's way too early to talk about restructuring of Greece, as you need to fund the banking system more heavily first. There's a sequencing here that needs to occur, and I think the markets have rightly spoken this week to scare policymakers enough to toe the line to buy some more time.
Doug Cliggott, critical question then. Are the markets speaking to scare policymakers in the United States? A 313 yield doesn't do that. Everything's wonderful, isn't it?
Well, I think the U.S. Treasury as an asset class, probably in our view, the most positive aspect to it is it's not correlated with anything else. So if you want to build a portfolio that maybe has some emerging markets in it, has some high volatility, high growth stocks in it,
right,
having treasuries as part of that portfolio really does make sense.
Greg, I want to get the last word in with you. Gabriel DeCock, your foreign exchange expert. Where's a dollar here in 6 months to a year? I get so many different opinions.
We think the tendency is for a slightly stronger dollar, just as things settle down on periphery. So our bias is towards a slightly stronger dollar, but we don't have a really strong call here on the dollar. What we do know is that a key driver of performance over the first several months of this year has been the dollar weakness, as that's been a dramatic driver of portfolio performance. I don't think you're going to see that same effect going forward. And so I think it's less of a prevailing interest.
Very good. Gregory Peters, thank you so much with Morgan Stanley. This is a stunning chart. We don't have the chart here. We're going to get Mr. Purcelli on, but he goes right to loans. He goes to the cash flow and the cash desire of the nation. You look at equity cash flows. How's the cash flow of the nation?
Cash flow in the nation really varies dramatically by whether you look at the household sector, the corporate sector, the government sector. What we're really seeing, Tom, is a transfer of cash from the government sector to the corporate sector. Government sector is sustaining demand, so the corporate sector can really control costs. Households are the conduit that it's flowing through. I think the real alpha and omega of the household sector is getting better sustained income growth, job growth.
And that's not there. I mean, year-over-year wage growth's not there, right?
It's still very, very sluggish.
You've heard me say Euro Swissies, what I'm looking at in Europe. Here's what I'm looking at in the United States. Bring up the chart, Rex, if you would. Inextricably entwined, which you see through a lot of financial literature. It's just the house price index. It's like a tertiary index, and from 1990 whatever to the top of the market, it was like boring. Who cared? Well, look at it now, and the first and second derivative of that index, Doug, I'm sorry, it's ugly. That's got to go into a lot of the interdependencies between what you follow in finance and what my viewers are feeling at home, isn't it?
It does, and I think one very concrete way for the vast majority of the American public, the most important asset is their home. On average, that price is still declining. It's one of the reasons consumer confidence is still pretty subdued. Unfortunately, there's both a cyclical and perhaps a longer-term focus here. Longer-term focus is very personal. I was born in '56, heart of the baby boom. I had 3 kids.
Is this going somewhere?
I know it's going to get
please
there
go
fast. It's going to get there fast. There was a lot of demand for 4- and 5-bedroom houses.
Yeah.
Right? My kids don't want a 4- or 5-bedroom
What do they
house.
want?
They want an apartment. They want 1 bedroom. So right now you have this mammoth housing stock for the baby boom, and soon we don't want it.
So it gets mispriced. It gets priced down.
It gets priced really far down, and what's going to be the hot item is a little house or a 1-bedroom apartment. That's what we're going to need. We simply don't need all these big houses anymore.